If we look at the top 5 S&P 500 companies in 1990, you have IBM, ExxonMobil, General Electric, Philip Morris, and Shell. Now, if you look at the top 5 in 2024, it's Apple, Nvidia, Microsoft, Alphabet, Amazon, Meta. And if you look at this chart, nothing really lasts forever. There's no such thing as a buy and hold forever in any kind of investment. And the top 5 S&P 500 companies right now, they're highly unlikely to still be in the top 5 over the next 10, 20, 30 years. But in this video, I have 2 stocks that I'm highly confident. I believe they will likely last for a long time, like at least 10 to 20 years. I believe they will still be here. I believe they will still be doing amazingly well. I believe they are immune to disruption and they're going to do well no matter what. And I'm very excited to share those stocks with you today. The first one is a stock that I own and I talked about it many times on YouTube. The second one is a stock that so many of you have been asking me to do an analysis on it. It's going to be very special. So if you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. Okay. Now the first one, and I'm going to try to make it quick, is Amazon. Amazon has a moat that most people don't really look at it. They look at Amazon Web Services, they look at the store, but they don't really look at the logistics of Amazon and how much square footage they have. They don't look at the Amazon's distribution network, which I believe is something that's very important to look at. Anyone can create some kind of a website, Temu or whatever, and start selling cheap stuff. But who could really replicate the logistics and everything that Amazon and the infrastructure that the Amazon actually owns and the fulfillment stuff and everything that Amazon has? So this is one of their best moats, and that's a physical moat. That's one of the best ones that are capital intensive kind of businesses. Those are very hard and to disrupt, and they're very immune from new companies coming along and killing their model. So that's going to be something that's very important for the future, and they have a lot of it. But it's not only about the Amazon store. They have the physical stores, they have third-party sellers, they have advertisement business, they have subscriptions like Prime, Audible, and a few others. They have Amazon Web Services and many different things. And now they have 3 businesses that are $100 billion plus in revenue. So they have the online store. This is $249 billion. They have the third party, which is the highest margin stuff, is $158 billion. Amazon Web Services is around $111 billion. And they have the advertising revenues, which has been rapidly growing from $19 billion in 2020 to now $58 billion at a 29% CAGR. And 5 years from now, I wouldn't be surprised if the ad business is also a $100 billion business. Then I have the subscription business, which was nothing, like $25 billion. Now it's almost $45 billion. It's growing like 15% a year. I mean, this is insane. Then they have the physical stores growing 7% CAGR and other kind of bets and revenues. But this is just amazing from a company like Amazon. And then they have like another 100 or 200 businesses. I put them on this chart. I mean, you need an entire day to go through all the businesses that you own. But I did put it up on X if you guys want to go and look at it. So they have a physical moat, which is their square footage, their distribution centers, and there's the logistics in general, which are very hard to replicate. And they have many different businesses where Amazon just became a household name, and people are so used to be using Amazon. And I mean, you can't really compare. They have like a 59% market share in e-commerce, I believe, in the United States. So it's just going to be amazing. But in addition to that, for the future, Amazon has many different things that a lot of companies don't have. And one of them is their own kind of humanoids or robots. Amazon now has 750,000 robots deployed. Each robot packer at the warehouse can replace 24 workers. Packers cost $1 million each, which only takes 2 years to recoup the losses. And this is a short video of those kind of humanoids doing the work in the Amazon facilities. And the technology that Amazon has in-house is just a massive opportunity, not just for them to find more efficiencies, but if they decide to license this technology out to many different companies, it would be it's like Apple before they had the services business. It's one of the biggest call options with Amazon that most people aren't actually talking about. about. And they're talking about using this technology for them to do the last mile delivery, meaning putting like humanoids into autonomous vehicles to kind of deliver things to your door. I'm not sure how that's going to work, and it's going to take some time. But the potential cost savings and margin expansion here, I mean, the upside is pretty much unlimited. And then I have the taxi business, which they're starting to roll out. I think it's called Zox or Zoox or something like that. And they have their first launch in Las Vegas. I don't know how that's going to work out, but I mean, it's been looking really good. Now, if I look at the valuation of Amazon, it's trading at 15 times price to operating cash flow. This is dirt cheap, guys. Like, it's really not expensive at all. For a company like Amazon, you're only paying 15 times operating cash flow. This is really not a lot. Now, the main reason why we use operating cash flow is because Amazon has a lot of capital expenditures. Most of it isn't in maintenance CapEx. It's not just for them to maintain their operations. Most of it is in gross CapEx because Amazon wants to invest in their capabilities for them to widen the moat and for the future. But Amazon can pull back this CapEx anytime, and it would be tiny, which is why we use cash from operations instead of using free cash flow. And I think it's a much better metric. And that's one of the things I like about Amazon is Amazon isn't buying back stocks. They're not doing dividends. They're reinvesting in themselves, doing acquisitions, doing many different things. So they're still finding value in themselves. And that's to me much better than a company doing buybacks or doing dividends. But 15 times operating cash flow is not expensive for a company that was growing operating cash flow 81%, 36%, and is expected to grow 20%, 23% over the next few years. And I wouldn't be surprised if they sustain 20% a year for the next 5, 6, 7 years before Amazon reaches maturities and then they pull back on CapEx and start doing buybacks or dividends. It's coming, but I don't think it's coming over the next 5 years, and I hope it doesn't come. And Amazon keeps reinvesting in themselves. So the first one is Amazon. They have a logistics, a physical kind of moat, but they also have an online kind of moat, and they have many things for the future that will set them apart, including their robots and humanoid kind of technologies, which will make them much more efficient. So you have a lot of margin expansion, and you have many different call options within space where Amazon is like trying to launch their own satellites or something to space, and so many different things with an amazing company, amazing CEO. So I like Amazon very much. Now, the second one, which is a buy and hold forever, I think it's almost always going to be here. I shouldn't say always, but it's likely going to be here for a long time. Many of you have asked me about this one, and this is Brookfield, BN, Brookfield Corporation. It's up like 2% on the year. But with Brookfield, you're getting a world-class CEO, which is Bruce Flatt. Bruce Flatt, if you don't know him, they call him the Warren Buffett of Canada. He has returned 19% a year for the last 30 years. It's just one of the best owners, operators, the best kind of CEO that you could have in the market. And he's just an amazing person, and he's very smart, very intelligent, and he's only 60 years old. So you still have a 10, 20, 30-year runway with Brookfield if you're betting on Bruce Flatt, which I would be betting on him if I decided to buy the company. And you have one of the best CEOs ever running the company. And that's, to me, is a major advantage. And Brookfield Corporation has returned 18% a year versus 11% to the S&P 500 for the last 30 years from 1994. So they have delivered a lot of value for shareholders, and I think the next 5 years to 10 years will be even better. But with Brookfield Asset Management, it's more kind of like a conglomerate, you could say, and they have three main businesses. The first one is their massive stake in BAM, which is Brookfield Asset Management. Brookfield Asset Management is like a toll bridge where you have many kind of endowment funds, many kind of institutional investors, many insurance companies, many sovereign wealth funds. They want to invest money in alternatives for high returns on their capital. So they give it to Brookfield Asset Management for BAM to manage the asset for them. Now, BAM collects fees on that, just like a hedge fund collects regular fees or an ETF collects fees. BAM will collect fees on managing the capital, but BAM also has something called like carried interest, where they have certain goals for the future, like a let's say a goal of 18% return. If they deliver above an 18% return, they get extra fees on top of that, which normally kick in a few years in the future. So this is how their business model is. They have over $1 trillion in asset under management. They grew it from $600 billion to $1 trillion in asset under management. And by the way, I'm using FinChat to come up with my chart. So if you want to try it out, they give you 2 weeks of free access if you want to use my link in the description. But they took it from $1 trillion. They want to take it to $2 trillion over the next 5 years. This is more than a 2x in total assets under management. And those assets, most of them are permanent. Like they said, 80 to 85% of those assets are kind of permanent. Some of them are Brookfield's asset being managed by Brookfield Asset Management, and some of them is Brookfield Asset Management's assets themselves, and some of them are locked in for like 10, 15 years. And this is a business that's always going to exist. You always need capital managers. You have 3 big ones. The biggest one is BlackRock. The third biggest one is Brookfield, and they own Brookfield Asset Management. So this is an amazing, amazing business, and it's going to be here forever. Then they have the wealth solutions, and they have an operating business where like they have real estate funds and other kind of infrastructure funds, and many different things on clean energy and data centers and a lot of different infrastructure and real estate kind of funds. Now, if you want to make it simple, I'm going to look at their largest business, which is Brookfield Asset Management. This is where most of their cash flows are coming from. Now, BAM itself, they're guiding 18% CAGR in their own earnings per share metric. Then they have the carried interest growing at a 51% CAGR, which what I told you guys about the performance fees into the future. In total, they're going to get 21% CAGR in distributable earnings from Brookfield Asset Management's distributed to them in dividends almost every single year. So that's going to be an amazing return from BAM itself. But if I want to make it short and look at the entire business, they're expecting their earnings per share to grow 20% plus annually over the next 5 years to $9.77 per share. Okay? Now I'm going to keep it very simple. And this is US dollars. So I'm going to take $9.77 per share. And I do trust their guidance. They have a lot of visibility, so they could even beat it. This is very, very possible because, again, they have a lot of visibility in their distributions and cash flow. And we time it by just 15 times earnings. Now, normally, BN trades at 20, 22 times from time to time. I'm going to put it at 15 times. Now, putting it at 15 times earnings, this is $146 per share. Brookfield right now is trading around $59. This is like 148% on the upside over the next 5 years with an amazing company like Brookfield, with a world-class CEO like Bruce Flatt, and with a business model that's like a toll bridge that's going to be here forever. You're always going to have capital that needs to be managed, and one of the best companies in place is BN, which is Brookfield, and then Brookfield Asset Management, which is also owned by Brookfield. So it's much more complicated. I could take an hour to explain this company, but I'm trying to keep things here very simple. So I see massive upside on BN, and with an amazing CEO, this company is likely going to be here for a very long time. And I'm also seeing Amazon, which they have a massive moat, infrastructure moat, online kind of e-commerce kind of moat, and they have a moat within their different businesses and how efficient they're going to be in the future with robotics. Most companies will not be able to compete with them on the price versus the reward that they're getting. So this is what I'm saying with Amazon. That's what I'm saying with Brookfield. That was my video for today. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.